on to the Smart Property Investment Show with your host, Phil Tarrant.
Good day, everyone. It's Phil Tarrant here. Thanks for tuning in to the Smart Property Investment Show. We have today something which is always anticipated. We try and do it once a month, a big Q&A session where we collate and curate all the feedback that we get. And I do thank everyone for sending in all those questions to editor@smartpropertyinvestment.com.au, and you can use that if you want to get in touch with us. But we get lots of questions, and we'd like to sort of pull them into themes so we can actually have a discussion around them. Today, I'm joined by someone who is very well versed to help me out navigate our way through these questions. Simon Pressley, who's the MD of Propertyology. Simon, welcome back to the show.
Always good to have a chat, Phil.
I know you do like a Q&A session with us, and we'll try and keep on track, but often I generally find we navigate our way away from it. But
easy to happen,
it's all interconnected. But Simon's a good friend of Smart Property Investment. We get him on the podcast as often as possible when he's in town. You're not based in Sydney, are you, where we record this from?
Based in Brisbane, but
on the plane a lot, aren't you?
On the plane a bit. We analyse markets all over the country, capital cities, regions, so we do a bit of travel. Yeah,
it's one of the questions I always get, and the liberty of being the host, I'm going to ask the question.
Digressing already?
Yeah. No, it's connected, but I often get people say, how can someone who, whether you're a buyer's agent based in Sydney or Brisbane or Melbourne, do you need to be using a buyer's agent that's in the place where you want to buy? And I'd go, no. But I'm going to let you answer that.
Yeah, look, it's a good question, and the answer is both a yes and a no, I think. If you are a homeowner and you're looking for a buyer's agent, absolutely, that's a great service. It's what most valuable asset you might put your money into, rather than be batting against the LJ Hookers, Ray Whites of the world. Engage a buyer's agent, and they should be local. But there's a different skill to help someone buy the family home compared to help someone invest. There are buyer's agents who help someone invest in the market of the city where the buyer's agent has their office, and then there are research companies, which is Propertyology, who have a buyer's agent service with it, but you still need to have quality assurance in place to find the right property on the right street and to help the due diligence. You don't have to have an office in that town to be able to do those things. As long as you do them so that your hard-earned investment dollar is protected, fine. But how you do it doesn't matter as long as you do it.
That makes sense. So do you need to use a buyer's agent that's based where you want to buy? The answer is yes and no. If you're buying a house to live in, as in your family home, and you know where you want to live and all the reasons why you want to live there, it's pretty much hey, I need a 5-bedroom house with a pool and a backyard that's flat, and I need a little granny flat so my mother-in-law can live in it, etc., etc. Then it's good to get someone who actually knows that particular suburb intimately and is based there. Whereas it's a bit chicken and egg. If it's an investment, it's not about, hey, I want to buy a property in this place. It's about, I want to find the best investment possible for my particular need and strategy and the point I am in building my portfolio. And that can be anywhere.
Yeah, I think people need to distinguish. There's a big difference between knowing your neighbourhood and knowing markets.
Okay.
If we're talking the family home, that's a personal thing, it's an emotional thing, and you need to enjoy it, and that's knowing your neighbourhood. But if you want to invest, where you live, where you go to school, has got nothing to do with it. It would be like a share investor saying, I work for CBA, so I've got to buy CBA shares. Well, no, they don't think that way. They've got the whole stock exchange. So to a property investor, your whole stock exchange is 8 states and territories, 550 city councils. A buyer's agent is not going to help you pick the right one of those. A buyer's agent will help you find a good property, negotiate a good price. But first, how do you find the market? Which market do you start the search in? That's where you need a research company to do that, and that's us and a couple of others do that.
So there's a big difference between a buyer's agent and a property strategist and a research company?
Absolutely.
Okay.
Yep. All
right. Well, that's my first question.
Yeah, good.
Let's get into the real question. So, and as you know, for those that tune in to our Q&A sessions, I keep this really raw, and I've literally been handed these questions by one of our team about a minute before we've come on air. So I'm reading this for the first time, and the reason why I do that is that you can get raw and authentic responses from me straight off the bat, and also from Simon. First question is, and what they've done here, and I'm looking through it, I'm going to actually start videoing these podcasts so you can actually see what happens behind the scenes. But I've got a really detailed question to start with, and then they've put together some curated stuff for some other questions which are a little bit shorter, and we could probably get through them a little bit quicker. But the first question says, hi Phil, love the show and have been an avid listener for well over a year now. always plenty of great insights. So thank you very much. By the way, this is from Dean Thomas. Dean, thanks for writing in. Dean says, I have a question for your next Q&A show, which was prompted by your recent show with one of the buyer's agents where you mentioned that you're rent vesting in quotation marks. I'm also in the same boat, renting in the Hills District with a young family and have 2 investment properties in Brisbane valued at about 1.15 million. Like most people, I very much regret not starting my property investment journey 10 or 20 years ago. And now in my early 40s, my wife and I have a bit of catching up to do. So investing where we see value and future capital growth is a path we've chosen. Okay. All right, Dean, this is where we get to the question. We're fortunate enough to have decent incomes and earn a combined sort of circa $300,000 is good money. The current investment properties only cost us about $200 a month before any tax benefits for both of them. So we have plenty of serviceability to purchase more investment properties, which we plan on doing. So the question is, what is a rent vestor's end game? Question mark. Rent forever and live off equity or rental income, or sell down and purchase principal place of residence? What is the right time for you to purchase a principal place of residence, with PPOR? Thanks in advance for any insights you can provide. All right, Dean, good question. So what Dean's chatting about, I had a conversation around that I hate the term, but I'll use it, rent vesting. I think it's a stupid term, but anyway. So I invest as an investor where I should be investing. That's got the best fundamentals for capital growth and yield and all the stuff that we always talk about. Where I want to live, I actually rent there. And I live in a nice place, and I can't see myself moving at any point in time. And at a point in time, if they come up for sale, I might buy them, but it would cost me a lot of money and it wouldn't be a good investment. Do you hear this sort of scenario a lot? Is it a fair scenario, good scenario, or it depends on who you are and what you do and what your long-term games are?
It's just so popular, isn't it, Phil, the rent vesting? I mean, it's always been around. Just someone 5 or so years ago gave it a term.
Yeah, but worst term ever, by the way. But anyway,
well, I guess at least we know what we're talking about. We hear it now, but people do it for different reasons. I mean, Propertyology's helped. For example, young people who live in an expensive city like Sydney, they can't afford to buy here, but they still want to live here or they work here, and plenty more affordable places around Australia. So they do as you're doing. There are others. We've helped people who work in the Defence Force, for example. So they know that every 2 or 3 years they're going to be transferred, and that's the career path they've chosen. They're often provided accommodation everywhere they move. So they earn their money working in Australia's military, and whatever they can save, they invest around the country. We help them do that. We've helped some baby boomers as the kids have moved out of home. They've got this, big house with only mum and dad living in it, and they realise that they might be sort of 55 years of age, 10 years left in the workforce. All they've got is a little bit of super and the family home. So some baby boomers have actually sold the family home, cleared the mortgage. If it's a couple living in Sydney, they might end up with, say, $800,000 cash in the bank. They then rent where they want to live, as you've described you're doing, Phil, and then they use that $800,000, introduce some debt and buy 3 or 4 investment properties around the country. So there's lots of different reasons for doing it. Dean's question about, does someone ever buy the principal place of residence? The good thing is there's no rules to life. Maybe for some. Some maybe never. Yeah. And when, I think for most people, they would sort of see themselves at some point in time buying a family home. But yeah, there's no deadline on when you need to do it. I guess the longer you can put it off, the more you can invest and get your money working harder.
And I think that's a really good point. The way I view this is, I live really near where I work, so I can. It's downhill on the way home. It takes me 10 minutes. It's about 15 minutes on the way to it. So I'm really close to. I live really close, and I don't want to commute. I don't want to deal with it, all that sort of stuff. And that's a positive. And I've got a young family, so I can nip home whenever I need to, and all that sort of stuff, which is cool. It works for me. But my view is that so outside of the livability for me to rent where I live and invest where I should be investing as an investor, for me it comes down to utility of money. So rather than having money sitting in a bank account waiting for me to buy my principal place of residence, which I will at some point, I don't know where I'm going to live, so hence the reason, but probably where I am. But So rather than that money sitting in a bank account, getting at best 2% interest, so for every $100,000 you get $2,000, you pay tax on it, a maximum tax rate. I'm getting utility with my money, so I prefer to park that in property and just amplify its benefit, multiple times. And I haven't yet done the math, but I reckon if I compared investing $100,000 in savings and getting $2,000 a year return on it versus that same $100,000 as a deposit for a property somewhere, I reckon I'm getting a lot more than $2,000 return on it, in terms of equity gain, but then there's also tax benefits associated with it as well. So the question around when you should buy your principal place of residence is going to come down to what's right for you, I think. And
when you're ready to settle down.
When you're ready, and it might be family pressure. I think a lot of people like this, the comfort and safety knowing that they're not going to get booted out of a rental property at any point and they can raise a family. It's very emotional, I'd like to think I'm a sophisticated investor like you are, and you work with a lot of sophisticated investors, Simon. I'm quite happy with the risk and reward of renting where I live on the basis that, maybe it might not be forever or it might change quickly versus the wealth I can create investing in property. So
it's funny, isn't it? Growing up, there's always been this stigma attached to rent money's dead money. I mean, complete load of hogwash, really. For anyone who's actually crunched the numbers. But for generations, that's what everyone said. No one ever questioned it. So everyone sort of thought, I've got to get a job, I've got to save a deposit, I've got to buy a house, because that's just what you've got to do. And that's what mum and dad did. But the thing is if people actually, even if they didn't do the maths, just have a look at all those generations before them who have done that. Most of them are going to be relying on a taxpayer-funded age pension. So how'd that work out for them? So a lot of the reinvestors have actually looked over their shoulder at what previous generations have ended up with when they reach the retirement years and go, I want something better than that.
And that's okay. It's okay.
That's okay. But I've got to do something different. And rent investing is not for everybody, but it's largely a numbers game.
It is a numbers game.
I mean, 10 million properties in Australia. It would be an absolute miracle if the best property you could buy just happens to be the one you want to live in. An absolute miracle.
It's really a tough one. So taking all the emotion aside as well, if you're thinking about buying a family home, you need to still think, yes, it's emotional. Yes, it needs to have a nice garden, a pool, and a place you can drink wine and stuff. And I often have this conversation with people buying their home to live in. Do the maths like an investor, because a lot of people say in Sydney, you're not going to get much change out of $1 million to buy a house, right? So say I buy a house, and let's use an example where it's kind of like the ponds, right, out Kellyville Way, new train line, all sorts of stuff, really, really popular. Spend $1 million on a house out there, and we'll get to numbers because I don't know where this is going to go, Simon, but you can probably help with it. Spend $1 million on that, so you're going to need a couple of $100,000 as a deposit. So 80%, $200,000 plus stamp duty. Probably another 40, 50 maybe.
50 probably.
50. If you use a buyer's agent, it might cost you another sort of $10,000, or your stamp duty, all your legal stuff. You're in for a lot of money, right? So say you drop $250, $260 on that, right? That's a chunk of cash to put into an investment. Now, if that property, and you're paying a debt on it, principal and interest, principal place of residence, you might get an interest rate of 4%. So for every $100,000 in debt, that's $4,000. For every $100,000 of debt, you're paying how much in interest at 4%? $4,000. Yeah, that's right. So extrapolate that out for multiple times. So 800,000 times by 8, right? It gets big, right? So if you're holding this property for this period of time and it's not going up in value as fast as the debt you're paying on it, it's probably not a good investment.
And none of those costs you, including your interest, are tax deductible. If you bought that same property, not that you would, but if you bought that same property as an investment, all those costs are tax deductible. So a lot of people love this idea of having a family home, but they go backwards financially by holding it, because it either doesn't go up in value, and therefore at a point in time when you choose to sell it, you can't realise any equity gains out of it, and it's potentially a cash flow burden. The biggest catch with the rent vesting is the capital gains tax. Obviously, you buy the family home, you sell it 10, 15, 20 years later, your profit's your profit. You pay your agent's commission and the rest is yours. But if you bought that property as an investment, there's capital gains tax. So, Dean's question there, that's a consideration at some point down the track as he's starting to consider to buy the principal place of residence. Where does that initial deposit money come from? But there's no law that says that you have to ever sell a property. You only pay capital gains tax
when you sell it.
If you sell.
Yeah.
And there are sometimes, to do what you want to do, it might be the only way to do that is to sell one or more properties. But there might be other ways that you can achieve what you want to achieve using equity. Everyone's circumstances are different.
And that's the benefit. So if you are a rent investor, you want to be renting in places, I imagine, which the primary goal of property investment is that the thing goes up in value and it costs you as little as possible to hold through good yields, right? So you park your money in investment properties, you can build it up, you can draw the money down and use that as deposit for equity. And you've bought well, you could potentially keep your properties at 80% on that basis as well, your investment property. So lots of moving parts.
Meaty question.
It is. What do you suggest? What should Dean do to help him make this decision, Simon?
I think each household's the world around them will answer that question. I don't know if Dean's says he's got a couple of kids, what age they are, job-wise, that sort of stuff. But there will come a point in time when you just have that light bulb moment and go, this is it. We're ready to settle down. I know we want to live in this particular city, in this style of dwelling, forever and a day, sort of thing. When you get to that point, and that's probably more a feeling than anything else, then you need to think about, well, how do I fund that?
Yeah. And a lot of people like the idea of retiring in a home or a house that has no debt on it for security, right? That's one of probably a major retirement goal for most people. Yeah. And most financial planners you see would probably say that's what you want, right? So at a point in time, you'll make the decision. Until then, keep chasing those investment properties. Thanks for writing in, Dean. Really detailed. And if you've got any additional questions around that, contact us. Same email, mate. editor@smartpropertyinvestment.com.au and happy to flick it over to Simon as well if he wants to give you any more details. Next question, shorter one, and one probably for you, I imagine. Simon, if selling in a regional market, what are the best ways to reduce days on market of a property? Okay, that's quite a big question.
It's an interesting question.
It is an interesting question. So you're selling in a regional market. How do you make sure it doesn't languish on realestate.com or domain.com with no one buying it for a whole period of time?
What I find interesting about it is why regional market. It's really any market. When you're selling, whether it's capital city or region, you need to meet the market. I mean, that's the key. If for whatever reason you've decided that you need to sell that property, you can want what you want in terms of a sale price, but the market will only ever pay what the market's prepared to pay. So, I mean, that's key, is being realistic, working out what is it worth, not what you want, because the buyer doesn't care what you want, what your debt is or anything like that. What is it worth? You can do that yourself, and a good agent will help you do that as well. Yep. A good agent will help you determine whether there's anything you might do to the property before putting it on the market. It doesn't mean the best and quickest way to sell a property is to always cosmetically improve it and tart it up. Yep. But you need to go through that structured process for your property. A really good marketing campaign, that's going to depend on where the property is and what it's worth, but whether it's best to go to sell it by auction or private treaty or tender, how you promote it. I mean, that's really it, whether it's regional market or capital city market.
To me, this question is a bit loaded, saying if selling in a regional market, pretty much going, it's harder to sell in regional markets than
it does imply
markets.
That, doesn't it? Which
it does.
Doesn't surprise me. There's so many Australians who, perhaps because they've only ever lived in a capital city, have the perception that region means risk.
Yeah.
It can.
Well, that's why I said it's probably a question for you, because I know that you're quite agnostic in terms of where you invest in property. You look for the best markets that show the propensity for growth and all the other fundamental indicators you need. So I know you do some work out in regional areas. And we're not talking the middle of nowhere, a town with 4 or 5 properties. We're talking about big regional centres, right? So can you paint a picture for me right now of our regional markets? Are they vibrant? Are they attracting people? Is there jobs growth, wage growth? And I imagine the answer is going to the response to that's going to be it depends where it is. But
it is.
Give us a quick snapshot, Simon.
That's a big question.
Yeah.
Look, capital cities and regions, there's risk in both. There's risk in investing, and if you're not prepared to take any risk, don't invest. Put it in a term deposit. I mean, Perth is Australia's 4th biggest city. Had 3 years of decline. Darwin's probably hasn't been officially described this, but I think is in recession. Capital city. Sydney and Melbourne, had price declines in 2011, or Melbourne had it again in 2012, and so did Brisbane. Anything can go backwards. But I think, I don't know what people think about regions, that like they think that people are going to run away. I mean, there are literally dozens of regional markets that these locations are 150 to 200 years old. and they've got more people that live in there today than what they had back then. So populations still grow. I'll say this. So the next 3 years, if we were to draw a line in the sand today in March 2018 and fast forward 3 to 5 years from now,
here we go.
We will see one capital city that's probably performed exceptionally well, and that's the market that's hot as now, Hobart. I reckon the other 7 will have done very little over the next 3 to 5 years. Some of those actually might be worth a little bit less in 3 to 5 years' time than what they are today. The best performed property markets will be throughout regional Australia, but there will be some that will have performed poorly, and some that will have performed exceptionally
all right,
well.
I'm going to hold you on this, Simon. So here we go. This is what journos love.
Yeah.
3 to 5 years. You reckon that the regional market's going to perform better than most of the capital city markets, and performing best means growth as a percentage term of their absolute value.
Yep.
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 Okay.
Yep. I mean, we've heard a lot about building approval volumes, record supply, but I don't think the public have really taken that in.
Yeah.
A lot of that is yet to wash through the system. We do know that Sydney's growth cycle is over. It's had 7 consecutive months of, albeit small, but price declines. That's a trend.
Yeah.
That cycle is over.
It is a trend. Yeah.
Melbourne's now had 3 consecutive months of price declines. Again, small declines, but I believe that is a trend that will continue.
The decline will continue. It'll be neutral,
probably more flat
neutral
now.
growth.
Yeah. And I don't think either our 2 big capital cities are going to crash. Their economies are too strong.
Yeah.
But the supply is significant.
Yeah.
And there does come a point in time when those who can afford to buy have all done so. And I think that's where we're at in our 2 biggest markets.
Yeah.
So, and if we look over the course of time, growth cycles come around between every 7 and 12 years. So our 2 big capital cities could remain flat for quite some time yet. Fortunately, their economies are strong. Otherwise, we could have some significant declines. Yeah. You go through the other capital cities. I mean, Brisbane has poked along, with its choke barely pulled out since the GFC. 10% dwelling price growth in 10 years. That's all Brisbane's seen, Australia's 3rd biggest city. Perth has gone backwards 6% in 10 years. I think Perth has flattened.
Yeah.
I think Brisbane will probably continue to just poke along. I think Canberra probably pretty much the same. Adelaide pretty much the same. Can't see when Hobart's going to stop. It'll end at some stage, but it's not on the horizon. It could have a good few years left. Who knows?
Okay.
So I think we've covered the capital cities. There's not much.
There we go. Well, I was going to ask you about that, but so
regions.
To summarise this region. So by the way, sorry, Craig, this is your question. Sorry to mention that beforehand. So yeah, it sounds a bit loaded. So I wouldn't want anyone to think that regional markets are harder to sell properties in, because that's not the case.
No.
There is properties that sit on markets in Sydney, Brisbane, Melbourne, wherever, for a long time, because typically they're either, to your point, they haven't been priced to hit the market, or someone's trying to sell it that doesn't know how to sell it, or they've got a crap agent who hasn't given you the right advice and the guidance in terms of how to market that property or present it best to sell.
I'm not going to say where, obviously, and the viewers will understand why, but there's a couple of regional markets we're investing in right now, and the property hits the market and it's gone. It has an open home on the weekend and it's gone Monday,
so
Tuesday.
So not to talk about locations, I'm going to ask you off air because I want to know, but and then I'll tell everyone, don't worry about it. But what would these markets look like? So they're not tiny regional towns, and I imagine they would have diversified economic base and maybe some government-based jobs there, or, is that pretty much a good summary?
Yeah. Look, I mean, we don't invest in one industry towns, and that's not to say people shouldn't, but there's obviously bigger risks in doing that, and we don't do that. But right throughout Australia, there are a number of regional cities that actually play the role of a mini capital city, and they service the smaller towns that might have a population of 5,000 or 10,000, but there could be half a dozen or a dozen of them within that region.
So you're talking regional hubs.
Regional hubs. So they've got all the essential infrastructure that a capital city has got. They've got a diverse economy. It's just a smaller scale of it, and literally, there would be 30 of those locations. They're in every state. So, but what they have that big cities don't have, firstly, they have affordable housing. We've bought properties that have been in the low 200,000s to never exceeding 500 grand.
Okay.
I've never bought a property for any client for $1 more than 500 grand. Okay. Most of them have a 3 in the front of the
And these are nice joints, right? They'll be sort of relatively new brick homes, 3-4
sort of thing you live in yourself if you lived in that location. So they've got housing affordability. They don't have these record volumes of housing supply that's been building up for the last 4 or 5 years. They've got different industries. So when there is a downturn with an industry, which happens, every industry has a downturn at some stage, there are other industries to still provide employment there. But we've all heard for a few years now that Australia is Asia's food bowl. It doesn't mean that people should rush out and buy farms. But thinking about what that term means, and specifically what food are we talking about and where are the jobs, where are the factories that are processing this food, where are the abattoirs? This is really the Asian century. It's not just going to hang around for a year. There's no farms in capital cities. And we've heard a lot recently about free trade agreements, the TPP, and the enormous boost that this is going to give you Australia's economy. Is that going to benefit capital cities, do you think? We think not. There's universities that are expanding in parts of regional Australia, which create jobs with those as well. Not all manufacturing sector is in a downturn. Some of those are expanding, especially food-related stuff. And tourism is really getting outside the capital cities now. Lots of regional airports are putting money in infrastructure. Lots of the regional airlines are flying direct. A lot of these places we've invested in for our clients. You can fly direct within 1 hour every day to Sydney, Melbourne, Brisbane.
All right, a lot of tips there. I'd be getting your Google Maps out and trying to search where these locations which have all these indicators. And I can think of a couple straight off the top of my head.
There's lots.
Just in New South Wales, there is some towns that has it got to be university? Yes. Has it got great infrastructure, including hospitals, etc.? Yes. Has it got established industries? Yes. Has it got some government-based offices there? Yes. And, go and check it out. But good point. All right. So don't think regional markets are harder to sell properties in. It's largely irrelevant. Just make sure you present the property the right way and it's priced to market. Okay, it's probably going to be the last one for today, actually. This question is from Leanne. Leanne, thanks for writing in. Member editor at smartpropertyinvestment.com.au. Question is, how can someone get started in property to gain growth with a low income? Apart from the obvious saving and living minimally, where can the best gains be achieved with low serviceability? Okay, interesting question. Let's try and summarise this. So the question I'll put to you, Simon, is that do you need to be making a shitload of money as a salary to be a property investor? Yes or no?
No, but what you need to get that first property is obviously a deposit.
Yeah.
And banks, being responsible lenders as they should be, will need to see more than just you've got 50 to 100 grand cash or whatever in the bank, that you've actually done something yourself as opposed to parents gifting that money to you. So they want to see character. They want to see that you're responsible with your money. And I think fair enough. But that's always going to be the hardest person, especially if you're one income and a low income. But until you've got that deposit, obviously you can't afford to invest. But we've just been talking about regional locations.
Yeah, well, actually, I'm going to do the next question because I just looked at it. So it's still on the regional theme. But we bought properties for clients $250,000. So, the listeners can do their own maths on that to work out, what sort of deposit do I need, whether they're going to incur mortgage insurance or not. But you're not going to get more affordable than that, and you're not going to get that in any capital city. And when you're buying at that level, really anything under $350,000, even with a small deposit, with interest rates where they're at, and are likely to remain this way for many, many years yet, the cost to hold might be $1,000 to $3,000. Yeah, a year.
Yeah. So holding the property's not hard. The hard thing is having that initial deposit.
Yeah. So my recommendation, I completely agree with Simon there. My recommendation would be start living like you've got a property or an investment property and actually understand how to budget effectively so you can satisfy the test that should you have an investment property that you can actually manage it and maintain it based on high serviceability as well. So don't be pricing it on, 4.5% interest rates. Think about how you're going to be repaying it at 7+% at principal and interest. And that's sort of factoring in some level of rate rises. So if you can do that comfortably, number one, it's going to help you save a deposit because you're going to have more cash into your bank at the end of the day. And then number two, when you do make the move to go into property, through experience that you can can manage and maintain it and not put any pressure on you. Because the last thing you want to do, if you are on a low income, and what is a low income these days? It's the average is about, what's it, $75,000 in Australia right now, nearly 80. So if you're earning $40,000-$50,000 a year, that doesn't stop you from investing in property. You just need to get to a point where you can actually satisfy the lenders that you can repay a debt and show them that you can actually save money. So if you've saved the money and then you're disciplined and you've got 2 years of history of saying to a lender, hey, look, this is the way I operate now anyway, they're going to be quite comfortable to give you that cash.
Yeah. So the rule of thumb we use with clients inquiring about our services is 60 grand. You really need to have 60 grand cash saved if you're a first-time investor. If you've got that, that will be adequate for your deposit, your acquisition costs, and will help you get into a good market. If you've got that, you will be able to afford the annual holding costs. And typically they might be, as I said earlier, between $1 and no more than $5 grand, and that's probably including a bit of a buffer in there. And
the key to that is that once you've done that once, so once you sort of accumulate a war chest of 60 grand so you can get your first investment property, getting your second one is significantly easier if you buy the first one the right way. So, if you buy well in a property with good capital growth, and you can realise that at a point in time by drawing down that initial 60 grand as a refinance and go again. And that's a strategy that a lot of people use, isn't it?
Absolutely. Yep.
Good. Okay, I'm going to go do this last question because it's, seeing that we're talking about regional areas. Peter, thanks for writing in, mate. The guy should have probably shuffled this up, so it was the one that we spoke about after if selling in a regional market. But if you are from a regional area on a lower incomes, all interconnected, and unable to invest in the city areas where capital growth may be better, how do you go about investing in a smaller scale initially to be able to reach a larger portfolio? Again, that's sort of connected in with both of them. Number one, just because you are on a lower income doesn't necessarily mean that you need to be investing in regional areas. But I think the challenge with this question is that capital growth is perceived to be better in city areas than regional areas. And I think you've dispelled that pretty quickly, haven't you?
Yeah, it is a perception, but it's an incorrect perception.
Yeah, it's an incorrect perception. So how do you know if a regional market is showing good capital growth versus a city market? It's just numbers, or is it real ground truth in knowing what's going on?
It's some numbers, but it's probably not the numbers that the listeners think. It's not change in median property values. It's not vacancy rates or auction clearance rates or those sort of things. What we place most of our research emphasis on is economics. It's jobs. It's how we picked Hobart. We started investing there when Tassie was in recession in 2014, but so that wasn't numbers, that was understanding what makes up Tasmania's economy, what's the outlook for all those different industries, and we had we felt very confident that was going to improve. Housing was affordable, supply was already tight. We backed our professional judgment, we bought, and now we've got all these clients that have got a booming market. So that's how you pick whether it's capital city or region, is really focus on understanding an economy, and which is not easy if you're not doing it every day. I do it every day, but listeners aren't going to be doing that every day. And then back your judgment. But so it's not numbers, it's is it tourism, is it agriculture, is it manufacturing, is it health? What are the industries that support the economy? What are the key players in that particular location? Are they expanding or are they contracting? And all these little dots, it's going to create a positive picture or a negative picture.
Okay. It's very regional centric, but I know you're an advocate of the right regional market. So the message is clear. Don't have blinkers on and think that you should only be investing in metropolitan areas. There is a lot of different people, a lot of different strategies. Some people solely operate in regional markets and have done very well there. So broaden your scope, broaden the way you view markets, and don't have prejudices on particular types of markets because of something you've heard from someone bloke at a barbecue, i.e. that regional properties don't go up as fast as metropolitan properties, or it's harder to sell properties in regional markets. And yeah, it's probably the truth sometimes, but it's the truth also in metropolitan and capital city markets as well. So
capital city or region, every market will go backwards at some point. Yeah. Every market will have booms at some point, and every market will have average years.
And that's why you need to be a researcher that understands macro and microeconomic forces which determines, the mind boggles if if you're tuning into this the type of research that guys like Simon does in his company, and a handful of some very other good property researchers and strategists in Australia, your mind would boggle the intricacy of the detail they get down to. So unless you've got those skills and capabilities, you're up against people who do that and are probably buying more effectively than what you are. So. I'm going to ask you about Hobart. I'm going to get back on the show, Simon. I want to do. You touched on it briefly, what's going on in the different states, but it's always really popular. I want to ask you some questions around the Hobart market.
Love to.
As in, has it run its course? Is it too late? Have you missed it? Where's the next joint? And I know you're cagey. You're not going to give me too many specific locations, but I think Simon's been very open on the sort of things that you need to be looking at if you're investing in regional markets. So that said, also, those same principles exist in a couple of markets. It's just good investing. So
yeah, absolutely.
Nice one, mate. Appreciate your time, Simon.
Pleasure.
Remember to check out smartpropertyinvestment.com.au. If you're not subscribing to Morning Market Intelligence, so you first know what's going on in property, you can join all the other smart operators in the market receiving this, smartpropertyinvestment.com.au/subscribe. If you like social media and that's how you like to get your information, just search Smart Property HQ on any of the social platforms. We'll be there. And remember, any questions, including, so thanks Dean, Craig, Leanne and Peter for writing in. We will get to your questions. So please do patient with us. We do get literally hundreds of these, but we will get around to them and keep writing in. That email address to contact is editor@smartpropertyinvestment.com.au, or you can tweet us as a direct thing and we'll answer that as well. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.